Hey, what's up, my friend? So, in today's episode, I want to talk about how should you average into your losses. So, for those of you who are not familiar with what that means, it means that as the market moves against you, right, you continue to buy even more. Let's say you buy a stock at $20, then the market drops, right? The stock price is now trading at $10. You buy even more stocks at $10. So you can see that as the price goes against you, as the market goes against you, right, you're buying even more. So this is what we mean by averaging into your losses, right? Your first position is in a loss, you buy even more as it continues to move against you. So before we talk about how to do it, right, I want to first and foremost share how not to do it. So most traders, they make the mistake of averaging into their losses based on emotions. As the market move against them, right, they want to average into their losses because they think that as the market make a bounce, right, a slight bounce, they could possibly get out at a much lower price at break even. Let me give you an example. Let's say you bought 1,000 shares at $20. Then the stock price collapsed to $10. And let's say you buy another 1,000 shares. So at this point of time, right, you have 2,000 shares long of this stock, let's say stock A. However, if stock A now were to rebound from $10 to $15, you're able to get out at break even. Had you not averaged into your losses. If you did not average into your losses, the stock price have to go from $10 to $20, then you can get out at break even. But if you average into your losses, you can see that you could get out at break even at a much lower price, at $15. So if you do the math, you'll see that that is true. But the problem with this averaging into your losses approach is that if you do it without a plan, if you do it without proper risk management, you could lose more than intended. So initially, right, you were buying 1,000 shares at $20. Then you average in at another 1,000 shares at $10. If you think about this, right now you're controlling 2,000 shares. And if the market doesn't bounce higher, if it continue to move against you, your losses are amplified further. And that's very important. That's something that you must be aware of. Averaging into losses is financial suicide if you have no idea what you're doing or if you're trading based on emotions. So now the question is, when should you average into your losses and how do you do it? Well, there are three circumstances, right, that I would say warrants, right, averaging into your losses. And number one, first and foremost, you have to manage your risk. You have to know how much you can potentially lose before you consider averaging into your losses. So first circumstance is this. You can average into your losses, right, when you are, for example, taking advantage of a crisis opportunity. So as of right now, we have the COVID crisis, right? A lot of asset prices around the world, they are plummeting like a rock. Oil, for example, right now trading about $25. And if you think about this, oil cannot stay this low forever because once demand come back, demand for oil will go up. So right now it's about $25 and I have no idea where the bottom is. I can't predict how low oil can go. So what I could possibly do is to, let's say for example, I want to buy some oil. Let's say I have $50,000 in capital to take advantage of this opportunity. But since I have no idea how low oil could go, I could put in the first $25,000 at $25 when oil is trading at $25. And if let's say oil dropped to, for example, $10, I can put in the remaining $25,000 to buy oil at $10,000. So you can see that from the start, I'm already prepared to lose, or rather to risk a fixed amount of money on oil. It's all part of the plan. I'm no longer, gambling or trading based on emotions. It's all part of a plan. I am really prepared, right, to set aside this amount of money to invest in oil. So that's the first one, right? Crisis opportunity, and you have no idea where the bottom is. You can, enter in trenches. For example, after the price or asset drop 40%, you enter one time. It drops 50%, you can enter a second time. It drops 60%, you can enter a third time. But before you can even execute this, right, you have to know how much money you're willing to risk. Very important. Circumstance number two, right? Back to trading. So you can also average your loss, right, when you are trading, let's say, at support resistance, an area of value, trend line, moving average, whatsoever. And this area of value is very wide. So let's say you're about to short, let's say you want to buy some Amazon stocks, and it's coming into an area of support. However, this Amazon stock, right, the area of support is not very clear cut. It's not like, at a very clear, obvious price level like $100. Maybe the area of support is between $120 and $100. It's a $20 area, and you have no idea where Amazon is going to find support. So what you can do is you can average into your trade. So let's say Amazon comes into $120 and you don't want to miss the move. You can buy, let's say, certain amount of shares at $120. Then if Amazon continues further down to $100, you can average into your losses and continue buying Amazon because it's coming to this area of support. However, for trading, you have to know when to cut loss. Eventually, the price could just, smash through support and go even lower. So you have to have a predetermined point, right, to exit the trade, right, if Amazon, collapse too low. Let's say your $90 is the point where, it's your last line of defense. If Amazon reaches that price point, you will exit all your positions. That could be done as well, right? So in this case, you are trading an area of support, but because support is a wide area, right, you can average into your losses as the price continues to move against you. But you must have risk management in place. You must know at what point to cut all your losses. So for example, let's say you are used to, risking 1% on each trade. So if Amazon first time comes to $120, you could risk 0.5% and maybe stop loss at $90. And if Amazon comes to $100, you can risk the remaining 0.5% and your stop loss still at $90. So in this case, if you get stopped out, right, the total loss to your account is only 1% risk to your trade. Okay, so moving on, right, the last circumstance, right, that you can use to average your losses is what we call dollar cost averaging. So this is a very popular term, right, in investing. So what you do is that every month you buy X dollars of an asset. So let's say, for example, the SPY, right, the S&P 500 index. So let's say you have no idea where is the top, where is the bottom. Every month what you want to do is to simply dollar cost average, right, into this ETF. So let's say you can buy $1,000 of SPY every month, right? So as the price, whether it goes up or whether it goes down, you just average into that position, into that trade. So what this does, right, is that you get the average price of this ETF, the SPY, right, over the long run. So in the bull market, you will buy less, clearly. And the bear market, since prices are low, you will buy more. So this is a kind of like a systematic way to actually trade or to invest, right, in the US stock markets. And this dollar cost averaging is kind of similar to averaging into your losses, especially when the markets are in the bear markets. Okay, I hope that makes sense. So with that said, I've come towards the end of today's episode and I will talk to you soon.